Hello, welcome back to the continuing lecture series in Principles of Finance. This is Dr. Jeff Hong, and we are continuing today to discuss the risk and return. Of course, remember, this is the third video in risk and return in this topic because at the end of the second video, I said briefly that we will be briefly leaving this topic to go into the stock valuation, and after we're going to come back after to this topic after the stock valuation. So there were six videos in the stock valuation. That was a long topic, right? And then there's going to be two more videos. Hopefully, just two more videos in this topic of risk and return. We already covered a lot about the risk in our last videos, two videos. But the risk, it was mainly about the mathematical and statistical side of the risk. In other words, how to measure risk and how we can use, return risk ratio to pick stocks, right? To pick an asset, right? To put it, very bluntly. Now, at this point, we would like to continue to actually to go to the source of the risk, right? Of course, we defined risk as the variance around the expected mean, right? But other than that, that's from the estimation perspective. But question was, the questions about the sources of the risk wasn't quite answered, right? In case of, remember, when we first started talking about the bond and risk of the bond, right? It was actually to discuss the risk premium, right? Remember, default risk. Of course, the greatest risk is the default risk, and liquidity and maturity and inflation risk. All those things were discussed in terms of bond and the cost of capital, cost of debt, right? But first, and then in case of stock, what would be the source? What would be the sources of risk? Just like in as we defined in the bond, pretty much a lot would be common because when it comes to basically financial assets, making an investment in financial assets, those things would. I mean, the greatest risk is default risk. Of course, in case of stock, it's not called default. I mean, you lose your money as an owner, right? If the business fails, you lose your money as an owner. But it's not like the borrower defaulting, right? In other words, you're not a lender, right? So losing your money is loss of due to loss of money, not default of a default of a debtor, right? So anyway, we need to just start with the definition of defining what risk aversion is. It's not the crucial thing at this point, but we all understand to some extent. Some people are more risk averse, and some people are more risk takers, right? Risk averse means you don't want to, and most of us, right? It's a human nature to stay away from risk, or even if even if it is inevitable, right? Even if of course, to invest, you have to take the risk. Without taking the risk, there's no return. But then, you would like to minimize the risk. That is, just a rational human being, right? Rationality is telling you to avoid, if possible, to avoid it at all. But if it is inevitable, to minimize it, right? So it looks like this. Then, think about it. We have two investments, and it's quite obvious. What does this show? There are two stocks, right? Or one both with the expected return, both projects or both investments have both stocks have the same expected return, and then this blue stock has smaller variance, whereas the red stock has wider variance. Then which one is preferred? Of course, mean variance ratio. Which one would have a better mean variance ratio or higher mean variance ratio? Of course, the blue stock, right? The same mean, smaller variance, you would have definitely a better mean variance. So higher mean variance ratio or higher return risk ratio, right? So blue stock is preferred, right? And we talked about this in the in the previous lecture, and there are two ways you can measure the input-output ratio. This is output to input ratio, but you can use the inverse gas mileage, right? Remember that. But anyway, if you use reciprocal of the this mean variance ratio, then it's called what? A coefficient of variation, right? That was in the second quiz, right? So, and then next question, right? It actually, over time, that variance would look like this. Remember, this picture is completely disregarding the flow of time. I mean, remember Apple's data we downloaded? It was over the last 5 years. But then if you put it without the time division, just like as if they are all coming from the same month, right? And you distribute it on a plane, it would look like this. But if you distribute it along the timeline, right, it would more look like this. It would look more like this, right, as time goes on, right? And obviously, when the business cycle, I mean, this side of the picture, this range of the graph is representing the upcycle, when the business cycle is good, right? When the economy is good, most businesses are in upcycle. So, as I said, most businesses are cyclical, so they would be, on upcycle, right? And this would be, when the economy is in down cycle. And stock B would look like this, right? Stock A would look like this, right? Now, and what if it is easy to pick it's easy to pick a stock if they have the same mean, because anything that has smaller variance is preferred as long as the expected return is the same. But if they have different means, right, or different expected returns, uh, it says neither preferred with certainty. No, you can tell as long as the numbers are given, as long as we can tell with certainty, as long as we know what is the mean, right, and what is the variance or standard deviation, we can take, mean variance ratio, and whichever comes up uh, with, higher mean variance ratio, that will be preferred, right? It just says neither preferred because with certainty because we don't have any numbers, right? Next. Which one is, uh, I mean, some people might say, stock market is, playing stock is like, gambling. Uh, to some extent, if you don't use any, I mean, if you have no training in finance, right, it would be like a gambling, right? But at least, you have, if you have training in economics and finance, it's not gambling. Now, what's the difference between gambling and investing? Look, in gambling, right? Uh, I mean, investing, the expected return is positive, always positive. Why? You wouldn't you wouldn't invest in anything, any stock or any asset that has negative mean value or zero mean value. Isn't that right? You wouldn't put your money into anything that has negative mean return, negative average return, right? You won't put in other words, negative expected return. You won't put your money in any stock that would have negative or zero expected return, right? Although the outcomes may be negative, right? Um, and because of the variance, sometimes you get negative return, but most likely you will get a positive return around the mean. But gambling, in case of gambling, the mean return is always negative. What kind of gambling uh, can you have, a positive expected return? There's no such thing. I mean, you go to a casino, right? I mean, why would casino lose money to you, right? They won't have that kind. I mean, if casino loses money to you, and if the expected uh, payoff to you is always positive, and expected payoff to uh, uh, the casino is negative, they won't be in that business. Make sense? It's only because their expected payoff is positive that they are in the business. And some people, might win money in the casinos, but then think about it. If someone hit a jackpot in the slot machine, so he got, $500. But until he got $500, how many, you know, bundles of $500 do you think he has lost? He must have lost like, 10 times, right? Like $5,000 he must have lost, right? In the past. And then only once the odds are like, 10 to 1, he lost, 10 times and just won, once. And then after this, he may lose again for another, 10 rounds, right? So in gambling, the maximum you can lose is 100%. If you lose all your per each, I mean, you're playing the slot machine with, $500 every time. Lose $500. That's 100% loss. You come back with another $500. You lose again, another 100% loss. And of course, if you win, the positive side is endless, right? I mean, you could, of course, in investing, um, uh, if you win, I mean, for example, if you had bought Apple in 1981, and that's what I always regret. I was um, in '81. I was a you know, junior. In 1981, I was a sophomore to junior um, in college, and uh, had I just known at the time about the company Apple, if there's time machine, I would like to go back to those days and put all my money into Apple. And over 40 years, it even more than grew 10,000 times. Mhm. Whatever little money I had at the time, I would have. But of course, uh, the probability would be very low. But if I mean, not especially if you're thinking of only 1 year timeline, of course that may not be achieved. But if I if I kept my money in Apple for 40 years, right? And both investing and gambling, right? In gambling, you lose for sure. There's a very high probability. This is like a good probability, right? Look at the tail. It's not like uh, very thin tail, very uh, big tail, right? Thick tail. Of course, investing, of course, you can lose 100%, right? But the tail gets thinner, right? That means the probability density is very low, right? Very thin. Now, probability density is very thin, right? The thicker this area, that's probability density is very high. Now, so it's just these are the examples of mean variance ratio. We're not gonna. So now we need to then think about the sources of risk. There are two sources of risk. Okay, to stock. One is systematic or systemic, and unsystematic or unsystemic risk. Actually, the words systemic and systematic are different in semantics because uh, systemic means it's something inherent to a system, right? Systemic failure means the system already has uh, built-in error, right? It's an error inherent to the system, so uh, this will lead to a failure, right? Um, but systematic means, something, methodical. I mean, if you're doing something in a systematic way, that means you have a system, and you do it uh, in a methodical way, using that, by that system, right? So, although the semantics would be different, but actually uh, they are used interchangeably in our context, right? When we are talking about the risk, they're used interchangeably, although they mean uh, two different things. But there is also, I would say, it started out as systemic risk because the risk is coming from the system they are talking about is the economic system, macroeconomic system, okay, and the uh, financial market, right? So it was originally systemic, but then there is also a systematic element to this. So hence, it came to be called also systematic risk. Okay, so uh, please bear with me. I understand. There are two things. You might be wondering. Oh, so where is that file? Where is this slide? This slide. Let me. This is a slide titled "Risk and Return." Right? That would be like. It's posted there, I believe. Let me check where in that. Where in the Blackboard it is. Let me go and check. I posted it there, right? At the same time, I'm checking attendance. Some people are. Course material. I posted it. If you go into the lecture notes folder, temporary folder. If you go into the temporary folder, right? Yeah, this is the file there, risk and return. It's not so it's there. The file is there, right? Also, let me see. And there might be a flicker. I don't know why. This is probably, if you don't see the flicker on the screen, that's fine. I mean, if it is, it may be kind of bothering to some people. Yeah. So, as I said, systematic risk refers to the risk coming from the macroeconomic system, right? And financial market, right? Financial market is directly affected by um, the events in the macroeconomic system, and is risk is the basically risk is the variation, right? Variation in caused by things that influence all stocks, political news, inflation, interest rates, most of all interest rates. It's macroeconomic, right? And then unsystemic or unsystematic risk is um, business specific risk. In other words, it's not coming from the macroeconomy or the financial market. It's risk associated with the particular specific nature of the business and the industry, right? Something like labor unrest, weather, death of key executives, and things like that. Whether hotel travel and tourism will be affected a lot by weather or pandemic and things like that. Labor unrest, yes, of course. Particular. So it can be summarized like this: the total risk, right, comes from systematic and unsystematic risk, right? Uh, Systematic risk comes from these five elements. First one is financial market risk, interest rate risk, reinvestment rate risk, purchasing power risk, and exchange rate risk. Right? So think about it. This is all coming from the macroeconomy. First of all, interest rate changes, right? It's macroeconomic factor. With the interest rate change, reinvestment rate would be affected as well, right? And we talked about interest rate risk and reinvestment rate risk already when we did, a bond. And purchasing power risk is what? Inflation, isn't it right? Inflation affects purchasing power negatively, right? Adversely, right? Or inversely, right? Inflation goes up, purchasing power goes down, right? And vice versa. Exchange rate risk, right? Exchange rate. Now, exchange rate affects a lot uh, the macroeconomy. I mean, there are two aspects to this. I mean, I don't have time to give you the examples of each, but one example is quite obvious. Any country that is exporting mainly whose economy depends on economy will be affected adversely when exchange rate goes up. I mean, what does that mean? When exchange rate if the exchange rate is low, right? Uh, what does that mean? If exchange rate is low, what does that mean? I mean, any country that is heavily dependent on export, when exchange rate goes down, that's not a good news. You might think when exchange rate goes, oh yeah, because you say, you might think exchange rate goes down, and doesn't that anything going down doesn't sound good, right? Uh, so if exchange rate goes down, isn't that a bad thing? No, actually, for um, it's a bad thing for the exporting economy, but not because of the reason you might think. First of all, what does that mean? Low exchange rate for example, between U.S. dollar and euro. Let's say the current. Let me use the whiteboard. Stop sharing, and let me use the whiteboard. Let me go to the whiteboard. So let's say let's call this exchange rate. That means exchange rate, and exchange rate between U.S. dollar and euro. Okay, and the exchange rate is usually defined as U.S. The domestic currency price. Domestic currency price over or per foreign currency price. So let's say 1 euro is $1.50, in US dollars, right? That means what? You have to buy 1 euro, you have to pay $1. I mean 1.5 US dollar, right? So that makes the exchange rate 1.5, right? Then you might think, okay, so what if exchange rate goes up? What if this goes up to 2? What does this mean? Exchange rate went up, right? And as the exchange rate goes up, what does that mean? Did US dollar get stronger or did it get weaker? If you say stronger, you're just saying anything that just comes out of your mouth, right? And if you have, I mean, if you're international students or if you have been traveling overseas a lot, you would easily understand. This means dollar got cheaper, right? Isn't that right? That means dollar got weaker. Isn't it right? Why? Because previously, with only 1 euro, you could buy 1.5 US dollars, right? But now with just €1, you can buy $2. Then what happened to the US dollar? Dollar got cheaper or dollar got weaker. Make sense? Right? You get it? So, so when exchange rate goes up, that is the depreciation of the currency, right? Depreciation of dollar, and vice versa. When exchange rate goes down, then dollar got stronger. For example, uh, uh, this went down to 1. What does that mean? There are two things that can happen. It can go up or go down. That means now it is $1 per €1. What does that mean? Before, to buy $1, to buy €1, US citizens had to pay $1.50 to buy €1. But now they can pay just $1 to buy €1. So which currency got stronger? Dollar got stronger, euro got weaker. Makes sense? Then this is the appreciation when exchange rate goes up, right? That's the depreciation of dollar. When exchange rate goes down, that's the appreciation of dollar, right? Makes sense? Then think about it. If your economy is heavily dependent on export, you're mainly exporting, and countries like South Korea, they all depend on a lot on export, and they export a lot of things. High tech, from high tech to low tech. High tech, of course, mobile phones, automobiles, all electronics, uh, memory chips. China is chasing right behind. Uh, uh, right behind. You might think China is um, ahead of South Korea. No, not at all. So, China is just large, very big economy, huge country with huge population, 1.6 billion. South Korea is only like 50 million. It's not even right. I mean, 10% of 1.4 billion is 140 uh, million, right? 100. So South Korea is not even 5% of, in terms of population, right? Uh, Almost, not even 5%, like 3% of the, population of China. And but the size of the economy, if you compare, I mean, South Korea is like 1.5 trillion dollars. 1.5 trillion. Um, China is about 12 trillion, somewhere around 12 trillion. So um, South Korea is almost like 10% of in terms of size of economy. So then think about it. You divide, 1.5 trillion by 50,000, 50 million people. What does that make? At least, per capita, right? South Koreans are making $30,000, right? If you simply, divide 1.5 trillion by 50 per capita, right? Including even baby, 99-year-old person, or right? By the whole population divided by whole per capita, uh, their annual per capita income is 30,000 at least. I mean, of course, it's because babies don't make money, right? Babies don't work, right? Actually, there are two uh, uh, per income earner, right? Annual income per worker would be probably about 50K, almost close to the US, but China, think about it, $12 trillion divided by, make it even for, $12 trillion divided by 1.6 billion. What does it, you know? So anyway, but the reason South Korea is that much ahead is because the technology-wise, South Korea is still ahead, right? Of course, I'm not, making little of, a potential of China, uh, but a lot of, and you understand, China as an exporting economy. True, China is pretty much, globally because it's so big, and as they say, factory of the world, factory for the world. So it's, churning out a lot of uh, goods, cheap to everything, cheap to expensive, low, but low grade to high grade, but mostly, it's still, a lot of things that are um, globally. Uh, exported or relatively on the low grade side. But one thing, think about it. With such a huge population, eventually China doesn't have to depend on the world market. They will, even just by domestic economy, right? Uh, they will have enough demand to sustain their own. Um, I mean, it's not at that point yet, but if per capita income goes up, then they don't have to necessarily depend on foreign trade, international trade. But a country like South Korea with a population less than 1 billion, right, and just half that, currently half billion, right, 50 million, right, they will have to rely on um, international trade, mostly export, because their domestic market size of the domestic market alone is not enough to consume um, everything that they produce, right? And their production capacity is way more than just what their domestic demand uh, can handle, right? And for an economy that is heavily dependent on the exchange rate, when exchange rate goes down, is this a good news or bad news? If exchange rate goes down, this is a bad news. Why? Think about it. Exchange rate is defined as domestic currency price over foreign currency price. So put South Korean currency here. South Korean currency is, Korean won, or, just like, okay. Currently about exchange rate is, of South Korea is currently about like 1,021. This is like a dollar 2 cents. It's not like 1,001 is sounds like a big thing, but they don't have any cents. So this is like 2 cents, right? A dollar two, and per US dollar, right? I mean, even if it is something like this, 1,201, that's like $1.20. That's like $1.20. And suppose this exchange rate goes down, that means what? Suppose 1,000 to $1, it's just like a dollar to dollar, or even lower, like 801 to US dollar. That means South Korean currency appreciated. And if South Korean currency has appreciated, what does that mean? All exported goods are becoming more expensive to the U.S. consumers. And since international trade is carried out in dollars, right? It's it's the called key currency, right? U.S. dollar, European euro, Japanese yen, Swiss franc, British pounds. These are five key currencies of the world, and all international trades are done, carried out only in these five key currencies. So for that means if one exchange rate goes down and it goes Korean won appreciates, this will mean a disaster to the Korean economy because their export becomes more expensive to the rest of the world, right? Their export suffers, then the GDP goes down, right? From $1.5 trillion a year now is going to go back to 1.3, 1.2. Then the per capita income will suffer a lot. So strong currency is not a good news for the economy, right? A weaker currency, especially for a exporting economy, weaker currency is a good thing. But I got a lot to talk about this, but I cannot spend a lot of too much time on this. So we'll just leave it at that. So exchange rate will affect the economy. That's that goes without saying. Companies, then you can easily understand that companies that are heavily dependent on exporting, companies that are exporting a lot, dependent mainly on exporting, right? International trade, their stock price will suffer a lot, and these are the factors that are coming from the macroeconomic system. Make sense? Now let me switch back to and therefore, right? Therefore, these are the factors coming from the economy, and that's why it's called systematic risk. And unsystematic risk comes from two aspects, two things. First, financial risk. Financial risk is, you might wonder, aren't we anyway? We're talking about the financial market. I mean, isn't everything about the financial risk? I mean, all the risks are basically financial risk. No, no, they wouldn't use the word redundantly, right? There's not, especially in disciplines like academic disciplines like economics, finance, science, math, statistics. One thing they hate the most is the redundancy, right? You don't use the same word twice, or you don't use the same, everything. Math is very terse language, isn't that right? In math, you don't use the same thing. I mean, one variable is not defined differently twice, right? You don't. So obviously, this doesn't mean, it's not that fluffy, okay? It's not like, everything is about finance. So no, it's not that fudgy, fluffy, you know, frill, right? There's nothing like fuzzy, fluffy frill in economics, finance, science, math. What this means is, then what does this mean? Actually, it means leverage. Leverage. What does leverage mean? It's the use of debt. It's the use of debt, right? So what it means is, you might also say, well, don't all the companies use some debt at some point and to some to some degree, to some extent. Anyway, they all use debt. Yes, true. All companies use, leverage or debt to some extent. But the degree of leverage differs from one in the industry to another. It's not like company by company. It's not by business, but uh, there is an industry. There are industries that are more prone to use more debt. Okay, and there are industries that are less prone to use debt. So what are those? Uh, and think about it. If a particular industry is more prone to use more debt, doesn't that mean that particular industry is more likely to be under heavy burden of debt servicing, right? Debt servicing means paying interest for the debt. Hmm? Yeah. Remember what capital structure is? If the capital structure is uh, 30% equity and 70% debt. What does that mean? This company is very, very heavily leveraged, and then whatever they make, their operating profit or EBIT, right? Earnings before interest and tax, EBIT, or operating income or operating profit. From EBIT, you have to pay out interest expenses, isn't that right? So you pay out interest expense, then what does it become? EBT, earnings before taxes, right? Now think about it. The higher the debt ratio, the interest expense would snowball, be huge. It will grow. The interest expense would snowball like a huge snowball, right? Then most all of the EBIT will be used to pay interest. Makes sense? Then what will you have left? You will have nothing left. Even for EBT zero, then you don't pay any taxes. You can't say, hooray, we don't pay any taxes, right? Uh, you don't pay any taxes because your profit is zero, and then you have nothing left. No EAT, no earnings after taxes, right? It could be even negative. Now, so that is the financial risk. The higher the leverage, there's more financial risk. The higher the financial risk. What does that mean? It's debt. So the higher the financial risk, the higher the default risk. Right? Makes sense? Isn't it obvious? The higher the financial risk, the higher the default risk. Right? That's about default risk. And I said it's not by company, but it's industry by industry. Why? Let's compare two industries. Airlines and restaurant. Airlines and restaurant. These two industries have something in common, but also something drastically different. First of all, they are both, they can fall into travel and tourism. Of course, airlines depend a lot on travel passengers, right? Maybe in the 1940s, 50s, 60s, mostly it was business travelers, but these days, mostly tourists. A lot of of course there are business travelers, but uh, restaurants they depend a lot on the travel and tourism. Uh, but the leverage, the capital structure in these two industries are hugely different. First of all, between restaurant and airlines industry, which one do you think is more likely to be heavily leveraged between the two? Some of you may say airlines without deep thinking. Uh, it just feels like, right? and and this is something you have to. This is the kind of habit you have to break out of. Just it feels like. You don't do anything. You don't jump into conclusion because of the spur of your feel. It feels like that's the area of uh, uh, mysticism and superstition. It feels like mysteriously. It feels like something mysterious led me to this point. That's something you see only in the movies, in novels. You should be able to logically explain and support your argument. It's not and something like, oh, something mysterious brought me here. That cannot be accepted, right? You will be laughed at. You will be a laughing stock if you say something mysterious led me to this point, right? You should be able to support and corroborate your argument logically, right? So if you say something like, I don't know, I just got a gut feeling, I had a hunch, something told me, airlines industry. If you say something like that, then you'll be in a pariah. I mean, especially in science, economics, finance, science, technology, engineering, math. You say anything like that, you will be up in pariah, right? And so then, why is airlines more prone to higher leverage? Think about it this way. You're starting out a restaurant, right? You want to go to um and how much? I mean, a restaurant can be a small scale or large scale. But if you're starting out a restaurant, right? You will start out, generally. I mean, it's a small business, right? What can you know, the total capital requirement would be not more than $1 million, let's say, not even. Let's say uh, $2 million, right? $2 million. So you think it's a small amount, so maybe it's easy to get a loan, business loan, or something like that. So you go to the bank. What are the chances of getting a loan? What do you think? Well, it's a small amount, so it's easy to get. No, actually, it's going to be very difficult. It's going to be actually more difficult to get a loan than airlines business. You might wonder what to start up an airline. It would cost a huge amount of capital, don't you think? I mean, it's not compared. It cannot be compared to a restaurant because even a domestic local airline, domestic airlines, right? I mean, if you're operating between, like uh, intracontinental flights from New York to LA, New York to San Francisco, New York to Seattle, New York to Houston, Texas, Miami. A domestic airlines, right? Or even a local regional airline. But what is the demand for regional? So mostly, domestic, right? Then airplanes would cost. No, I mean, you have to have a fleet, and a fleet would involve a dozen aircraft, like Boeing 737, 777. What would be the price of one airplane, like Boeing 37 or 777? Tens of millions, probably hundreds of millions of dollars. And to have a fleet, that means times, at least 10 or 12, right? And it's a huge capital. Um, how can you raise that capital? You might say, oh, sell stocks. First of all, you're starting off. How can you sell stocks? If you're starting off, you are a total big question mark. You're a big question mark, right? But then, how can you raise capital when you're a big question mark? I mean, you're not even listed in the stock market yet. You're not accepted in the stock market. right? Even if you're not listed in the stock market, outside the stock exchange, you can sell like penny stocks, but the penny stocks are that's like, when you are privately held, you can sell penny stocks. But, what are the chances of, an airline that hasn't even started up, right? What are the chances of, selling penny stocks and, raising capital that way? It's better to start crowdfunding. Now, but the idea is, uh, so raising capital through sale of stocks is, just impossible. It's unrealistic, right? But then, is it realistic to get a loan for like, almost, billions of dollars um, from a bank? And since you are a startup airline, and will the bank, uh, will they lend money to you gladly, even with, reservation? Will they? Doesn't seem like it's going to happen, right? But actually, yes, they will lend money to an airlines industry. Why? First of all, remember, it's for the same reason as they lend money to you to buy a car or to buy a house, right? I mean, have you seen these dealership commercials at night? If you watch TV late at night, then you hear these. You see these commercials. You need a car. You have a bad credit, no credit. What do they say? No problem. Why do they say that? No problem. I mean, you have a bad credit. You have derogatory credit history and bad credit, no credit. How can they sell you a car? And you know how financing works. You have to make a down payment, and they say zero down, no problem. You don't have to make a down payment, zero down, right? How can they? What what makes it possible for them to sell you a car with zero credit and zero down payment? Huh? That means they are lending you, the entire price of the car and let you have the key and for why? For one reason. What is that one? Because the cars become collateral by themselves, The so in other words, they're not lending you for free without any collateral. The minute you buy the car with the borrowed money, right? The car becomes the collateral, right? Remember that? So if you miss payment, then they will repossess the car. They will sell it off, right? They will recover the residual value on the car, right? They will put it again for sale, uh, and then they collect, payments again on that, car. And until you miss the payment, then they collect the, you remember the amortization. They get the interest and principal repaid, every month, right? And the same thing with the house, the mortgage. Why do they give you the mortgage? Because the house becomes a collateral automatically. And just like that, in airlines industry, right? If they lend you the money, you buy them. You buy you use them to buy airplanes, right? Boeing 747. They become collaterals already. And if you default, and they foreclose on that on those aircrafts, and they sell it off. They auction off those aircrafts, right? Or uh, so they get their money back, and then lend the money again to another borrower, and until you default, they collect payment, interest and principal, right? So that's the reason uh, airlines industry is more likely to get the loan, even though it is in huge amount. And compared to that, what does the restaurant industry have to offer as collateral? Huh? Oven, refrigerator, meat locker. What is the most expensive asset, capital asset of a restaurant business? Maybe the meat locker, right? The freezer. Oven, I don't think oven would have that much collateral value, right? Um, so that is the financial risk. Okay, industry financial risk is different, and what is the business risk? Business risk is really specific to that particular business. For example, you've seen it for yourself. Now, during this pandemic, what happens to the restaurant industry? It's devastating, right? No restaurant business. What about the travel and tourism? All devastated. Airlines all devastated. But IT industry um, devastated by the pandemic? No, on the contrary, they are actually thriving. Zoom, right? Google Hangout, all these, uh, you know, internet uh, conference apps, and I mean during the as people are locked down, everyone, you don't you can't go out, you can't eat, dine out, or you can't travel, but you are spending more Wi-Fi time, right? Online, you're spending more time online. So obviously, IT industry is not hit by the pandemic, but most other industries are hit by pandemic, right? Pharmaceuticals not hit by pandemic. Pharmaceuticals are doing better. You see, um, so that's something specific to different um, industries, right? The factors that. So the important thing is of these two risks, right? Systemic and unsystematic. Unsystematic risks can be diversified away. What does that mean? Uh, you you construct a portfolio, and your portfolio will consist of different companies from different industries. And as you have more and more different industries, at least like 15 to 12 different industries in your portfolio, the ups and downs in each industry will, and the different degrees of financial risk will cancel out each other. I mean, it may not, depending on how well diversified they are. If it is well diversified, meaning every industry is your portfolio is collection of every industry, and they will uh, almost cancel out uh, unsystematic risks. Hence, it's called diversifiable risk because the unsystematic risk can be diversified away. But systematic risk doesn't benefit from, there's no benefit coming from diversification because diversification cannot uh, eliminate systematic risk because systematic risk is coming from the economic system, macroeconomic system. It affects every industry across the board, all equally, right? And then so diversification cannot help reduce the systematic risk, but it will reduce non-systematic risk significantly. So let me show you graphically, it can be represented. This curve is the total risk of the portfolio. And in the portfolio, right, if you have just one stock, the total risk is this high. This is the entire risk of the market, right? The systematic risk and non-systematic risk. And these are the numbers of stocks or assets, securities, right? The more assets you have in your portfolio, about 15 to 20, then the total risk drops drastically. Total portfolio risk drops drastically. But what drops is the unsystematic risk part, right? Unsystematic risk comes to almost to zero, but it never reaches zero. It's called asymptotically zero. Asymptotic means it's reaching it's approaching the axis, but never touches the axis, right? Asymptotically zero. Uh, so by the time you have about 20 assets in your portfolio, your risk is mostly down to the systematic risk only, and unsystematic risk is completely diversified away. Okay, makes sense. All righty, so that's it for today. So we'll continue in the next class. Okay, thank you for watching, and I'll see you in the next class. Okay, end of video.